Hi, everybody. This is Jason Matthews with Matthews Financial Insurance Solutions and Gibson Monroe Wealth Advisors. Today, Jerome Powell, head of the Federal Reserve, who I call the most powerful person in the world, talking about how inflation and interest rates might hold higher for longer. So back in December, we heard that interest rates might be cut because we saw that inflation might be going down. But in return, what we have seen is inflation has been actually going up right now compared to where they are. So current U.S. inflation rate right now is at 3.48%. And right now, the Federal Reserve don't see interest rates dropping even further. At one point, we heard there might be a pause when it comes to interest rates. But right now, what we're hearing is not a pause going on, but we're hearing that a streamline of higher interest rates for longer can happen. So, how does that affect a lot of retirees? A lot of people are asking. First and foremost, it affects retirees depending on your situation. So let's talk about the first. We have a couple, they're homeowners, and they're getting ready to retire. For these type of people, this is actually an excellent time for them, for retirees. The reason being is this. If we look at the last 15 years, we was in a 0% interest rate market. And in that type of environment, it was fantastic for people who was borrowing money. We saw a huge amount of money in venture capitalists. We heard about unicorns such as Uber and WeWorks and all these huge companies, but it hurt retirees. The reason it hurt retirees was these low interest rates that happened made retirees take on so much risk to generate a certain amount of retirement income that they needed. So, for instance, if they had $1 million in the bank, they were getting 1%. In the 1% on $1 million is just $10,000. So it's unfortunate they could not live and suffice for the retirement. But now in this current interest rate environment, inflation has went up, but not as high as the current interest rates are, where right now we're seeing that they can get a lot higher rate than what they're currently receiving. Right now, they can get over 5% in the bank. So if you get $1 million, 5%, or any type of fixed income, now they're receiving $50,000. That's a huge turn of events. So if you're a retiree who's not borrowing money, but now just living off your retirement, this is a great time to have some of your assets in fixed income. But what we see in equity markets is we're going to see a lot of volatility we're thinking right now. So as a retiree, this might be a good time to reassess your money that you have in your money market, your CDs, your savings, and even some old annuities that you might have. Well, if you're a retiree and you have a rental income and everything, you're still working, this might be a more expensive time for you because one, your energy costs have went up. PG&E went up the board, but more importantly, we see gas prices increasing. And if you're working every day, that's adding more towards your commute. We also see it on your auto and home insurance rates. See, the good thing about being a retiree on a fixed income already not working is that right now you're probably not driving as much. So automatically your auto insurance rates probably have went down. But if you're working and commuting, then that situation is one. Another thing is if you're borrowing money because you're thinking about borrowing a home, using credit cards, or have lots of debt, that debt has got a lot more expensive. So now it's a lot harder for you to retire. Now, with all that being said right now, everybody's situation is different. But one thing we should look at is basic people. If you're a saver and you have your savings under control, this could be a really good time for you. While if you are a borrowing money, which we see record high credit card debt in this country, this could be a very challenging time. But at the same time, we see a lot of rockiness in the markets, a lot of wave of volatility. So we have to be very cautious right now when it comes to the equity markets. And so with that being said, I hope these tips and advice helps all you guys out understanding how higher interest rates will help out. Because down the road, instead of being 5%, it could go up to 6 or 7%, which is going to be a lot more attractive for a lot of retirees compared to borrowers who are going to see the cost to borrow money costs a lot more. Hope that helps you all out. Talk to you later.